Well, hello there, everybody. This is Morris from SJADVISOR.com and SJOPTIONS.com. And we're going to be looking at Karen the Supertrader's bread and butter strategy, the short strangle. But I want to look closer at what would have happened to the strategy back in August of 2015. So I rebuilt her trade according to their advertising, and we're actually looking at a chart, the risk profile of the SPX on August 17th, 2015, after the close. And what's interesting about this strategy is as the market moves around, your margins can change rather quickly due to the gamma of the trade, which gives you this frown shape. If you look at the dark line there, that's created by the negative gamma. But then the trade also has a very strong negative Vega, which you see down here, and also has a very strong negative gamma. And so as the volatility changes, the margins also change on the trade rather quickly. Before we get started, though, we're going to look at how the margins are actually calculated according to the TIMS model, the TIMS model. And one of the simplified versions of the TIMS, they simply will look at a risk array of 10% in either direction. So for example, as I move here up 10%, and you can see that the top right corner of this little information box, it'll show you the percentage moving the cursor. So this is about 10% up. And then from here on the bottom right, I can see my the risk or the P&L, and you'll see that it's 1.25. So in this case, I only used 125 contracts. I only used that many because the way we design the software, as you can see down there, that it's not displaying all the digits. So it's trying to keep the number of contracts smaller. But we would have to actually multiply this position by 100 to see the true position that Karen the Supertrader would have had. So in other words, this particular risk at this point would be 125 million. So they advertised, they used about 50% of their margins, and then they also advertised that they had about $250 million under management at this time. Now if we move over here, then we'll see that the risk is 451,000, which you see on the right side. Again, you have to add a couple zeros. So this would be 45 million over here. And then on this side, again, you'll have 125 million. So let's look at that for a second. So this is where your greater risk would be according to the TIMS. And then somewhere over here was the minus 10% mark. So you have a plus 10 over here. Again, right now I'm just explaining how they're calculating the margins. And then over here you have the negative 10% mark. And so they call this the risk array. And here's your at the money. And then they create little slices. And they check the risk at each of those. So they correspond with the day step line like this. All right, something like that. And so they'll look at the risk here, 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 and all these different slices as they go down 10% and up 10%. And then the software will locate where the greatest risk is in that risk array, and they'll make that your margin requirement, which corresponds over here. And then in this case, we have to multiply it by 100 because I didn't use all the contracts. Okay, so it's really this amount and multiply by 100, so it's 126 million for this trade. So this is theoretically about what Karen Burton's fund possibly could have had on something similar to this on August 17th, 2015. This trade is out about 50 something days, like 53 days, something like that. Okay, so now that we discussed how the margins are calculated, there's another component to the margin system where they also calculate $37.50 per contract. So if, excuse me, if she had about 1,250 contracts, actually 2,500 times 37.50 gives you another $93,750. Okay, so there would be an additional $93,750 added to the margin requirement on top of that 10% risk array. So now that we know where the margins were and basically how Karen was sizing her account according to their advertising, she also said that at times they would actually get up to about 80% of their margin. So this is a rather conservative analysis of what they were doing. So again, in this analysis, we're looking at 125 million, and we're assuming the account had about 250 million. So we're looking at about half of using about 50% of their buying power. So now we also have to look down here, and again, add in a couple, move the decimal to the right a couple. So you're looking at, as you can see, the Vega position on this trade would be about negative 2 million to start with. Over here, we see that, let's take a look, it's about the same, where it gets a little bit worse, it looks like. So as we're over at the negative 10% mark, you can see that the Vega position has changed over negative 3 million. On top of that, the VAMA is negative, so it gets even worse when the volatility rises. Okay, on this side, we can see that the Vega position is also negative. You see it stronger here, and then it flattens out a little bit farther this way. So we have negative Vega going this way as well as negative Vega going this direction. So one thing that's, again, structured very poorly in this particular type of trade is the negative Vega all over here on this side. So again, as the SPX drops down, then there's an inverse correlation of price to volatility. So the volatility moves up. And then especially with the large moves. So if you're going to see a move that goes like 5% in a day or 10% in a week, that type of scenario, you're going to see the volatility go up 100% of the time, and you can back test it and gather your own empirical data on that subject, and you'll see that the correlations are extremely high. So needless to say, when the market comes down this direction, let's just draw a picture here. So we have like our, let's say we have our Vega, and then we have our P&L. So this position has about negative 3 million Vega. And so as we go this way, the volatility increases. And for every point it increases, then you're losing $3 million. So back in August, that period, the vols went up about 20 points. So it's approximately 60 million. And that'll be like the loss created. Okay, so you have a Vega, again, which we were looking at down here, that was shifting to the negative 3 million, which is caused by the positive Vanna position behind the Vega. But also you're going to have an increase in volatility. And so approximately, there could be about a $60 million loss over here. But when we looked at the the modeling, it was only modeling about 40 something. So somewhere in here, it was modeling about a 45, something like that, $45 million loss. Okay. I think the vols went up even more, about 22 points. So it could have been maybe closer to 70. And then also with the negative Vama position, this Vega position gets worse. So the losses could even get $80, $90 million, maybe even $100 million. So we'll take a look at that. Okay, so now I've just fast forwarded the date to August 24th. And so you can see that we were over here, but now we're over here. And then again, with the volatility increase, the entire day step line, the black line here, has moved down, as you can see from the increase in volatility in the negative Vega, negative Vama, and positive Vanna position. So from there, we can see what happened. So as we were just discussing, the TIMS model had a margin at that location of about 45 million, but the trade actually lost $87 million. And that's what I was just explaining a couple minutes ago. So with the negative Vega position on the trade, the negative Vama and the positive Vanna positioning the trade, once we actually moved down quickly to that location, actually resulted in an $87 million loss. Again, you got to move the decimal over a couple because I didn't have space for that. So add that in, and then you'll see that it's an $87 million loss. So let's just kind of back up and summarize and recap what we just looked at. Okay, so let's say Karen's fund, let's say they had 250 million, maybe 200 million, and then they have on this trade with $125 million of margin, using up their buying power, so maybe 50 to 60%. And then just within a week, this one particular trade results in a drawdown, again down here, of close to $90 million. Okay, so the first thing we recognize is that the margin started with 125 million. Okay, but the loss on the trade is 87 million. I'll just round it to 88 million. So we have an $88 million loss in just a week, and where the margin was 125. Okay, so nearly, well, let's just calculate it. So that's a 70% loss. So if their account only had 125, then they would have just lost 70% of the count in one day, essentially, but it was, trade was on for about a week. Now, if they had started with, let's say they were at 200 million, and then they just lost the 88. Okay. So now they're left with 112 million. But the other thing to note, and we're going to calculate it right now, is the new margin requirement. Okay, so we have 112 million left. But let's see what that new margin is. All right, so from here, now we have to measure down another 10% in either way. And so from at this point, if you look at the bottom right, you'll see that the trade is now risking 217 million. So they have 112 million left, but the new margin requirement is 217 million. So essentially they have a margin call for $105 million. So it's either put in 105 million to cover this, plus they would have to have more because they would still be margined out, or they have to size down. So again, let's assume they don't have 105 million extra. So now from this point, Karen's fund would have to size down the trade, and again, their account only has 112 million left. So if they're using the 50% margin as a guideline, they have to get the trade down to about 60 million. All right. So in order to do that, one thing they could do is, well, they can roll the trade back out, but to keep it simple, I'm going to just buy some puts and reduce those margins. So now that I bought in some puts, I've flattened the risk curve enough so that when I go 10% this way or 10% this way, then they have just enough to cover, the additional losses. Well, actually, probably not even quite, because you can see here at the 10%, the risk is still 140 million, and they only have 112 left, so I'd have to probably buy even more. But anyway, the point is, what I want to show you is this. So notice by adjusting and trying to cover the margins, and we didn't even close out quite enough. Look where the zero line is. So zero is here. And at this point, the bar, which is, I coined that, I call it the bar. So your expiration line up here, which I call the bar, is still 42 million below zero, and I didn't even close enough of the puts out. So it's probably going to be 50 million, 55. So in other words, if things went smoothly after this and they made all the money, or they just did the best they could on the trade, they're going to lose somewhere between 42 and maybe 60 million on the trade. Again, because they have to size down, they have to liquidate a lot of the trades at a loss, and then the best they can do, if the rest of the trade goes smoothly, is they're going to finish the trade entirely below zero, and possibly with somewhere between 50 and $60 million loss. But you can see that the trade, at the moment is already down 90 million, so they're just trying to make back maybe 30 million on that trade. Okay, let's go back to the beginning and look at the initial credit. So now I'm back at the original trade, And again, the bar in this case starts, and you can look at the bottom and see it, the bar starts with about $6 million credit. So we can see in just one volatile week, this trade theoretically, according to what they were doing, could have lost maybe 60 million. They were down about 90 million, so who knows how much they made back. But they're trying to make 6 million every 2 months. So for an entire year, they're looking about maybe 36 million if the year goes perfect. Okay, which is about 18% or so on their entire account. Okay, so they're trying to make 36 million in a year, but you can see how one bad week can lose $90 million. And essentially 1 week can wipe out 3 years of returns. So that's about all that we have in today's lesson. And again, I hope that that I'm reaching a few people out there that are considering doing the short strangle. You can see that again, there's so much risk involved with this trading strategy, where again, one bad week that's really unpredictable can wipe out like 3 years of those returns. And we didn't even cover the realities of actually trading. What we were looking at, or assuming you would get filled at the mid price, and that wouldn't happen either. So once the market is coming down so quickly and you're just moving this way and the market's just like free falling, and then you're forced to buy back all those puts, the market maker has all the leverage. So as you put in your order to cover the put, let's say for like 20, they raise it up, and then you put in another order and they keep raising it. And so, at that point, the market maker has all the leverage, and they know that you have a naked position, you're trying to get out. And so the damages, could be much worse just by the slippage that's caused, during that type of market. And so, again, there's a lot of potential danger in this strategy. I really was hoping to work with Karen and her fund, but due to their advertising, where they were claiming that they were making so much money, I didn't contact her, because I just thought they already had something that worked according to what they were claiming. Unfortunately, otherwise I believe I could have totally helped them, and this never would have happened to them. So be careful. Yeah, if you're looking at this trading method, the main points I want you to take away from the lesson is, number one, your margins can increase tremendously. So let me look at that one more time. So let's just revisit August 24th once more. So you can see here, again, if you look at the bottom right, the new margin, as you measure down to 10%, then the new margin is 217 million. So this trade, again, started with 125 million margin that quickly jumped to 217 million. So it went up about doubled. So that's one thing that I want you to really think about when you're planning these trades. Well, first of all, in my opinion, you should never do this trade for those reasons that we just looked at. The Vega position is it works against the changes in volatility, so it has an internal Greek positioning that's very harmful and detrimental to the trade. So for that reason, I would certainly never recommend this type of trade. But secondly, you can see that the margins in this case doubled, and so again, if you're ever doing this trade, make sure that you understand that your margins can double in one single day. So like if you're using 50%, you're expect that you're going to get a margin call because it's going to go up to 100%, and then as you saw, at the same time your net liquidation goes down. So they crisscross, and then this position ended up in a margin call of over $100 million in one day. All right, so make sure you're aware of that, and then again, that'll force you to size down, and then once you're in the trade, you're pretty much guaranteed a huge loss. Like this one lost probably at least 60 million. They were down 90 million, and they might have made a little back, but due to the the trade starting with too much leverage in the first place, you just, once you get behind, you can't possibly make a comeback. So anyway, the other thing, let's take one look at, according to the SEC report, what they were doing. I guess I read in there they were selling 3-day calendar spreads. So let's just end the class looking at a 3-day calendar. So here's a calendar, just really short term. This was actually 5 days. And again, I don't know exactly what they were doing. But this one's like a little bit in the money with the puts. And you can see that even this type of trade is extremely risky. I don't know if they flattened the delta or not, but basically they could get a really short-term gain over here, but this way it'd be a loss, and then I don't know exactly if they were doing at the money, in the money, or whatever, but as far as I understand, they were trying to collect some short-term premium on selling a short strike, and then whatever the loss was on the other one, or maybe they would win on both and close them both out, or it's really hard to say. But anyway, they probably lost a lot more on the calendar as well, because the short-term 3-day calendar, as you see, also has a lot of risk, depending on how they were doing it. This one's in the money. Let's look at one that's a little bit closer to the money. So here's one closer to the money, and you can see what this looks like. So if you're right short term, again, you have some profit potential in here. But with any small move, even 1% move, you're losing a ton again in either direction. See, 1% over here is a big loss, and 2% is way over here. So I wouldn't be surprised, if the short-term calendars they were doing to try to quickly make up for the losses, just compounded those losses and made things even worse for them. So I don't know. It's just obviously much better to never really dig yourself a hole like that, and don't put yourself in that type of situation where you're trying to cover up losses. And again, the lesson here is you really have to thoroughly understand the margins, understand what could happen, understand your position sizing, understand how Vega works, how Vama works, how Vana works, how volatility and price correlations work, and understand how to create trades that actually work with volatility instead of against volatility. Also, you can see that you really have to do a lot of stress testing and back testing before you go live with a trade. And also you can't rely on just kind of winging it, you know, and like believing that when a situation arises, you'll just figure out something. You have to have everything predetermined. You have to have your rule set in place that you can execute. You also don't want to design trades that put you in that situation where you're forced to trade against the market or trade against the market maker. Like, again, trying to cover naked puts as the market's crashing is not a situation that you ever want to be in. Again, because the market maker could just keep raising the price on you, and then you don't get filled, and then really you're at the mercy of the market maker in that situation. So you don't want to put yourself in that situation either. So just a lot of things to think about when it comes to option trading, and it's not as simple as you think. So make sure you do a lot of testing and a lot of work on your plan, your money management plan, your risk, your hedging. Try to trade with volatility, not against it. And again, work with those margins and plan out your money management. So there's a lot of thought that goes into trading. So make sure you really put in your time. So I hope that helps. Thanks.